Welcome to the program. My name is Andrea Wilcox. I'm the Executive Director at the Kingsport Office of Small Business Development and Entrepreneurship. Today I'm sitting here with Scott Key, who's with Southeast Community Capital. Scott, thanks for coming.
Thank you. It's a pleasure to be here.
Well, I asked you to be here today because capital actually is one of the biggest challenges that small businesses have, and I'm sure you'll agree. And what I think the viewers would want to know is, what are some of the things that they must have before they come and make that visit with you? What are some things that they ought to bring with them on that first visit?
Absolutely. I think anyone who wants to start a business or even has an existing business needs to have a business plan. And if you've been in business for a couple of years, you need to continually update that as the market changes. You also want to be prepared to know exactly what kind of capital you're looking for and what it is for. You want to be very clear about what the needs are and your repayment plan, which can also be part of a business plan or a budget. And if you have it available, you might as well already bring some taxes and a personal resume, because those will be requested at some point, and it's always best if you have it ready to go.
How far back on the taxes should they be prepared to share?
Typically 3 years is mandatory. Also, if you want to show further back, maybe some higher profitable years, that's fine as well. But 3 years typically is the mandatory. And that's going to be personal and business, because at first they're going to look to see how the business can repay the loan. And the second piece will be any downtimes. Is there other available income to help support the business?
And so if it's a startup and they don't have the business taxes, would their personal taxes then?
Yes, absolutely. And if you're going to start up a business, most certainly you want to bring your personal taxes. And then the very important piece of that will be the business plan and your cash flow pro forma. Since there is no historical records, the bank can only go on potential earnings, and those are a little less predictable, so you want to make sure that you have a firm plan, marketing, management, and then also financial. And you also should be prepared for any startup to have at least 3 months of working capital available before revenues come in.
Okay. Now, does that include the down payment?
And that's the other piece of the puzzle, yes. It's going to be very hard to find 100% financing from anywhere, unless you're trying to bring on an equity partner. So prior to getting money, you should try to bring some at least 10 to 20% of the capital needs. If that can't be in the form of cash, other assets, maybe inventory, or maybe you own a building where it's going to be, that can be considered your equity investment. So it doesn't always have to be a liquid cash injection.
Now, what about collateral? Is that different?
Now, collateral will be another piece of the puzzle, but yes, absolutely. All loans are going to need to be secured by some assets. If you're an existing business, most likely you'll have some assets with that: furniture, fixtures, equipment, any type of inventory. As a startup, typically you're going to have to kind of look at your personal collateral to start it out, as there is none with the business at that time. It's very common to use maybe a second on a mortgage or other personal property to help secure a loan.
Now, what if you're not the 100% owner of that collateral?
If gets a little sticky, it depends. If the person who's going to be in the business with you is another owner, that's not an issue. But if they are not affiliated with the business at all, you would have to have some type of agreement where they're comfortable with you pledging that collateral. Because at the end of the day, you have to look at collateral as a liquidation value. And if there's an issue liquidating the collateral, it's going to be less attractive and valued. It will still be something you're bringing to the pot, though. And what I tell a lot of people, before you even try to go to get a small business loan, if you have equity in your home, that's usually the first place to go.
And what would be small?
I think a typical small business loan is anywhere between $25,000 and $50,000. Also, even 10 or 15 are through some other organizations. And some small businesses consider $100,000, $150,000 a small loan. So it really just depends on what you're doing, what your market is. I believe that if you're at $2 million or under, you're still considered a small business in revenues. And I know that does vary according with SBA. It depends on the industry. Absolutely, yes. Those size standards. Another question that I'm often asked is, when we have a startup and they're going to buy a piece of equipment, they'll want to use that new piece of equipment as collateral. Is that a possibility? Absolutely. However, since like you buy a car or any other piece of equipment, it's going to devalue pretty quickly. And so it won't be able to stand by itself more than likely.
To be 100%.
Exactly. So depending on the situation, they probably will ask for some additional collateral, whether that's assets of the business or some other personal collateral. Also, personal guarantees are going to be varied, and that's just the owner, whether it's a corporation or an LLC, they're also going to be typically going to be signing for the loan as well. And that can be not considered collateral, but it is, it's going to be something else you're bringing to the pot as far as securing the loan.
I think the other thing that people tend to ask is on the collateral piece. If say the loan is for $100,000 or $150,000 as an example, do they have to present $150,000 worth of collateral? A lot of times it seems like you want a lot more collateral than $150,000.
Yes, and every financial institution is going to be slightly different, whether they want 2-to-1 or 1-to-1 or even 3-to-1, $300,000 worth of collateral. And I think the way to go about that is there's other mitigating factors. So if you are purchasing $100,000 worth of equipment and there's no other real collateral as far as property or assets there, perhaps maybe a very high credit score, or if it's some profitable years, some other mitigating factors, the principal's experience. A bank and a lender may look at that and be comfortable. So it's kind of when one piece of the puzzle is a little weak, you want to look at some of the stronger pieces of the credit. You can look at the other side of that. Let's say someone has really poor credit and perhaps the business has just hit a downfall. Maybe they lost a large account, or maybe it's just a time like this, a rough economy, sales are going to go down. However, maybe there's a lot of collateral there, and so even though the sales are weak and the credit's been affected, the collateral can mitigate that. So, you always want to have good credit, have a lot of collateral, but that's not always the case.
Right, and that collateral has to be free, doesn't it? It can't be on another...
Yes, well, with vehicles, most certainly, it's got to be lien-free. Homes, you can take up to thirds on that.
Okay.
And a lot of times with a small business loan, they're not going to scrutinize the true equity in that. It's not like going to the bank and actually refinancing your house and pulling out money. It's more to say that you're 100% committed to this. For example, if you're borrowing $100,000 to start a business and you can only bring $10,000 to that, essentially the bank is taking 90% of that risk if this were to fail.
Okay.
Which is a large, investment on their part. And at the end of the day, all they're receiving is their interest payments. There's no true equity if it takes off. However, in that case, you want to try to bring in as much as you can. So to say that I'm willing to post my house just shows that you're 100% dedicated to this, and you would bring more to the pot. You just don't have that.
Yeah, a lot of people resist, don't
they? They resist that.
They don't believe in the business idea that strongly, it seems.
Yeah, and you have to realize as a business owner that you are asking a financial institution to invest in this business. And there's risk there, and they always have to kind of look at the contingency plan at the end of the day. And the more you can put into the pot, the more you're willing to offer up, shows how dedicated you are to the success of this, and that when there are hard times, you make the lender feel comfortable that you're going to work with them and get through these and not walk away from it because you have a minimal investment.
Right. Now, what about term? Does it depend on what you're going to use the money for?
Absolutely.
On a loan? Okay.
Yes, the terms of a loan are very specific to the needs. Whether it's a working capital, whether it's a line of credit, which is typically interest only. Excuse me. Whether it's interest only and usually is restructured at the end of the year, or a permanent working capital line, and that's typically going to be 3 to 4 years. And that's when you're borrowing for working capital and maybe inventory. Now, if you're specifically financing an asset, such as a piece of equipment or a building, then they're going to look at the asset life. Typical equipment will be 5 to 7 years, depending on what type of equipment it is. And for a small business real estate purchase, you're typically going to be at 12 to 15. They're not going to view it typical like a home mortgage where you get to 30 years. And that is because with the business, you assume the revenues will ramp up and they can pay down that loan quicker. So those are typical terms. Also, there's a bank and financial institutions can do certain structures that help you. If you are a startup business, it's going to be very difficult for you to make principal and interest payments those first couple months. So sometimes you have an interest-only period, or a bank can maybe say, we'll do a 3-year term, but they'll amortize the loan over 5 years. And what that means is your payment will be lower over the course of the first couple of months. However, there'll be a balloon payment of a large principal in 3 years. And what that does is it frees up some cash for the business in the startup phase, and then hopefully within those 2 or 3 years, the business has built up a nice cash balance, and they can pay down that loan.
All right. Well, can you share with me some of the types of businesses that you like to work on, that you like to come in and see you? Are there certain businesses that are more attractive than others?
There are, and as far as small businesses, they're all great. And anytime someone takes the time to put their efforts and hard money into that,
look at it on its own merit first.
Yes, but yeah, unfortunately, there are some more attractive businesses. Any type of manufacturing or wholesale contract-based businesses, that's very strong. More retail or restaurants are more difficult because you don't have large base clients. It's individuals coming in, spending, and you're more about turnover and the amount of people you can get in your place of business.
Now, as one of your goals, you're looking for job creation. Isn't that correct with your organization?
Yes, our organization specifically looks to create jobs and community development.
So the more employees.
So the more employees, the better. Also, if you're in a low-income area, that's important. A lot of places, a lot of the money coming from the government, they want to create economic development, not just in the larger areas such as the Knoxvilles and the Nashvilles, but the rural areas, Hawkins County area, down in Greenville.
Okay.
Trying to create jobs there.
Okay. And what about women business owners, minorities?
Yeah, women-owned business and minority-owned businesses are what they consider disadvantaged businesses.
Okay.
And you actually don't have to be a minority-owned business. Disadvantaged businesses can be in areas that have low income, because essentially that's disadvantaged because you don't have the market that other people do. So just because you're not woman or minority-owned doesn't necessarily mean you're not a disadvantaged business and you can't apply for certain funding.
Now, how about the unemployment rate? Because right now the unemployment rate is pretty high in a lot of areas.
Absolutely.
And I think that was a factor as far as being a disadvantaged area.
Yes.
It has been. So how do you treat that when the unemployment rate is pretty high all around?
Yeah, well, unfortunately, the state kind of keeps track of that. And so if there's a drastic change in an area, it may not be caught up in the system, so it wouldn't be considered an empowerment zone, a HUD zone,
even
or
if
a disadvantage.
Temporarily.
Temporarily.
Right.
However, we can still look at that. You know, we know that, so that's something we'll look at. Maybe it's not classified as that area, but we'll put that into our decision making.
Right. Now, you have a new office here in Kingsport.
We do.
We're so glad to have you here in town. And I think one of the things that the viewers would want to also hear and understand is how you're different than a community bank or like a Bank of Tennessee, First Community Bank, Citizens Bank, some of our local banks. Don't want to leave out anybody, Regions Bank. You're a secondary lender. What would be the correct term?
Some say non-traditional lender.
Non-traditional lender.
The way we look at it is when you're starting a business, there's three phases you're financing. Typically, before a company can get that traditional bank financing, they use equity, whether it's from friends, family, their own personal, or they find an investor.
Okay.
And then after they can grow the business a little bit through that, they look for that traditional financing to help secure equipment, property, or maybe provide some working capital to get a product made while they're waiting for payment.
And that would be through the bank.
That would be through the banks. However, you know, especially in this tight lending environment, the banks have really had to cut back. And they can't do a lot of financing that they could do back in the. So what we have done, and we actually partnered with a lot of our banks to create a large fund to help us fund those banks that aren't quite, fund those businesses that aren't quite bankable. And our typical loans is 3 to 5 years. We'll do longer terms, but that way we kind of would hope by that time the bank has graduated from the company has graduated from our program, and then can go into a traditional banking relationship. And we would encourage that. And then we have no prepayment penalties either. So even if you are financing a longer term asset such as a building, and 5 or 6 years down the road your business has gone to a new level, you can definitely have a bank come in, take that debt out, maybe at a lower rate, more attractive, and I think that's kind of what we always, that's our goal of all our companies. Fortunately, we had to get rid of the best ones.
Right.
So we're kind of that secondary, you could say, that non-traditional source for companies that can't get the equity, or you don't want to use credit cards, and they're not quite ready for that traditional source.
Now, is it true also that if they've gone to their traditional bank and they've been turned down, not because their credit is not good, but because of their being a new startup, then they could try and fill out the application, come and see you?
Absolutely, and I actually would encourage everyone, if you're to talk to your local banks, come talk to some of us. There's other SBA lending sources, and maybe perhaps a bank can do a portion of it, but they can't get to the the entire piece. So we'll be happy to come in and maybe.
So it could be a partnership.
Oh, absolutely.
Okay.
You have to really kind of shop yourself around when you're trying to get financing, see what's out there, and when you are talking to these lenders or an organization such as ours, listen to what they're saying. If they can't give you money at that time, they'll probably let you know exactly where you need to get and what maybe you need to accomplish before they can.
Right.
And that way you can set goals and be ready here in the future to obtain financing.
Now, we were talking about this, doing this program yesterday, and one of the things that we mentioned, I think you'll remember, we were, what are some of the things that we just should advise folks not to do in preparation for getting a loan? Some of the big no-nos that you've seen. How can we help people to, when they come to see you, that they're prepared and they haven't fallen into one of these pitfalls?
Yeah, and I think there's all types of pitfalls. Be wary of the credit cards. That's a very typical source for startup businesses. It's easy to obtain, the payments are low. However, you can really get that caught up.
Now, do you do the debt refinancing?
We will refinance certain types of debt.
Certain types.
Depending on the situation. However, we won't take out a credit card debt. So be wary of racking up $50,000 in credit card debt and then trying to come take that out. A bank typically won't do that.
Okay.
Now, if you have a loan with the bank and maybe some...
It's a personal loan, but it's for your business.
Yes, or you're trying to refinance that or help with some cash flow needs, we'll typically can look at that and potentially refinance that. Also, with people purchasing business, I've seen this a lot. Make sure you get a lawyer or appropriate business evaluation before you sign anything.
Right.
I've seen a lot of people purchase existing businesses at very, very high prices that were unfortunately overvalued.
Right.
And though it is a good business and it's producing income, the debt burden that's been put on them gets them in big trouble.
Yeah.
So always be aware when you're trying to purchase a business.
And of course, always get those 3 critical financial documents, which is the balance sheet, income statement, statement of cash flows for the past.
Yes, and I realize that a lot of startup businesses, or maybe you don't have the experience or those know-how. However, there's so many organizations such as yours with Kosbe, the TSBDC, have free services that you can sit down and put all your ideas on paper so you have your business plan.
Right.
And then one of the more difficult part is that pro forma cash flow. Sometimes that can be intimidating to people. They haven't worked with maybe an Excel program or actually put all the numbers down, but that is very crucial to know what it's going to cost to keep your business open, and then also kind of break out what are your fixed costs and what are your variable costs.
So what is pro forma for those that don't know?
Pro forma is where you look into the future. It's nothing more than a budget, and that's crucial for existing businesses, but extremely crucial for startups since there is no revenue history. And that way you look at a month-to-month basis of what you expect for expenses and revenues. It can show cyclicality of the business. If you're a retail, you're going to have really high sales probably in the winter months towards Christmas, and there's probably going to be some downtime. And that can help your lender know what type of facility set up and when you're going to have cash flow needs. What it also can do is you want to figure out what it costs to keep your business open, bare bones. Assuming you're selling no products, what it costs to keep the lights on, your employees paid. That's your fixed cost. That's what's going to cost it day or month in to month out to operate your business. And then whether you're selling a product or a service, it's good to kind of break out your cost of sales. And knowing that it's going to be $20,000 or say something smaller, $2,000 a month to keep the business open. And then for the variable side, for every dollar of sales, it costs you 50 cents. So therefore, you're going to need to at least make $4,000 in sales a month, because that will be $2,000 for the cost of sales, which will net you $2,000 a month, which will just cover your fixed costs. That is very important to understand that, so you know what kind of goals and what revenue sources you need to hit. And if you're not going to hit that, or if there's a downtime, to kind of look at your fixed costs and what can you shed, where can you cut costs. It's very important in tough times like that to understand your business and the ins and outs of the cash flows. And that's especially crucial when you're talking to your bank, because then you're much more aware of what your financing needs are, and it saves the bankers some time going through the financials if you can point out where the needs are and where those cash flow gaps are at. And that's, again, if that's not just for startup businesses, an existing business should always put a budget together, regardless if they're trying to get financing, because at the end of the day, that's going to help you keep track of your business and make strategic moves when market changes and the economy changes, such as it has.
Now, what if I've got a client who has a contract to perform work, and they just don't have the cash that they need to get the job going? They're capable, they have the people, but they need a little bit help with the upfront money to do the project. Can you help anyone there?
Absolutely. We would call that contract financing or purchase order financing, depending on how it's set up. And absolutely, especially when new businesses, they get a large contract for several $100,000 or $50,000. However, they're not going to get paid on that, especially if it's a government contract. You may be waiting
it's going to take a while.
Out 60 to 90 days. We have a product where we will finance up to 80% of the cost of sales. And again, that goes back to, you don't want to have the bank doing 100% of your financing. You want to try to put some money into that. And so if you can cover 20% of the cost to provide a service, provide a product, we'll come in there, we'll provide the other percent of the financing, we'll do something of an assignment, a contract, to where you'll pay interest only on the facility. However, you don't need to pay it down until you get paid. However, when you get paid, we want to be paid back as well. And then you can kind of roll this over. You don't want to get into a situation where you just have this open-end line of credit, per se, and it just builds up, because you want to pay that down, lower your interest cost, and then when another need comes up, it's much more easier to borrow again. And that way, if there's a 30, 60-day window, we can wait as long as you can. It's just the key is you want to make sure you make payments as you've arranged with your bank. And
now, how do you verify that contract or purchase order? Is there a verification process?
If you are a new company and this is one of your first large jobs, we're going to make sure we're, the control of the funds, and we want to keep an eye on you. Not because we don't think you know what you're doing, we just want to help you along the way. And so we will make sure it's a sound contract. We'll look at the company providing the contract, and it's important to see what the sustainability of that company is. Because if for whatever reason that company were to go down, you've lost that revenue stream. And what we do with that assignment of contract, we actually do an arrangement with the contractor, and we will take a percentage of that payment when they receive payments.
Oh, okay.
And what that does is it helps the borrower kind of control that funds, and they get paid.
Make sure you get your money back.
And we work with them. We make sure whatever percentage we're taking, they have enough money coming back into the business to run it.
Sure. We
don't want to have any more cash flow problems, but it needs to get into the appropriate practice of paying down that line and when you get paid. And that's difficult sometimes, especially when things are tight. You want to pull that money in, but at the end of the day, you're going to run into problems because you may overexpose yourself, and then when you really need money, you can't get it.
Now, what about for the folks that already have a loan with you? The SBA is coming out with some new programs in terms of financing, and one of the products is the stabilization loan. And my understanding is that they can use that to pay another loan, to repay a loan, as long as it's not an SBA loan. Would they be able to use something like that to pay a loan that they had with you? Are your loans SBA loans? Or
just like a traditional bank can do, we do SBA loans.
You do?
Yes, it's just one of the products we offer.
But not all the time.
No, absolutely. We have very other.
Necessarily be an SBA loan.
Absolutely, especially when you get into the larger loans. That's where we have to tap our other funds we've set up. Our typical SBA loans are $25,000 to $35,000.
Okay.
And anything above that, we typically pull out of our other funds, such as the Rural Opportunity Fund, which is one of our new initiatives, which has brought our office here to Tri-Cities. And we've also opened an office in Jackson, and that fund is specific for rural areas of Tennessee.
Right, and what's rural? Can you give us some examples? Is it based on zip code? Is it based on...
for our purposes, if you don't live in Knox, Davidson, or Shelby, you're rural.
Okay, all right.
So that, I believe it covers not all the 92 counties.
Okay.
That number's probably not right. So pretty much anywhere outside of Knoxville, Memphis, or Nashville, that fund is effective.
Okay.
And the reason that works is we already have a Knoxville-based fund and a Memphis-based fund. And we also have some other USDA products where if you need to do a large real estate transaction. So there are various sources of funding we pull from. And as far as the repayment, not too familiar with the stabilization loan, but as far as any products or facilities you have outstanding with us, you can pay those down with any type of funds at any time, no repayment penalty at all.
Oh, good. Okay. All right. Now, what about if I have a client who's purchasing a building and they're not going to occupy 100% of the building?
We can do up to, you must be 50% owner occupied for our organization.
Okay.
And what that essentially means, we can't do speculative real estate where you're maybe purchasing a large office building to lease out. However, if your business is going to occupy 50% of that and then you want to bring some additional revenue by leasing it out, then you would qualify for our loans.
Okay. All right. Great. Well, it's been a pleasure to talk with you.
Thank you. It's been a pleasure. Thank you for having me.
I think you've answered a lot of questions. Why don't you tell our viewers how they can reach you and where you're located?
Absolutely. We have opened an office at 160 Commerce Street, which is in downtown Kingsport. It's right down from the Chamber where Andrea's Cosbe office is at. And if you're familiar with Kingsport, we're right between the Haggle Shop and the Barefoot Chameleon, two wonderful retail outlets. And you can also reach me by phone or email. Our office number is 423-247-4500, and I can be reached by email at key@sccapital.org.
And if you didn't get a chance to write all that down, you can certainly come to the Kosbe website at www.kosbe.org, and we'll get you there.
Yes, and our website as well, www.sccapital.org.
Thank you for coming.
Oh, it was a pleasure to be here. Thank you.